Imagine this. Two people decide to start investing in the same year. One waits until they have what they consider real money, maybe $10,000, maybe $20,000. They spend years thinking about it, researching strategies, worrying about risk, and waiting for the perfect moment. The other person starts with just $100. Not once, every month. No complex strategies, no day trading, no trying to predict the market. Just a simple system and consistent investing. Fast forward 15 or 20 years, the person who waited might still be waiting for the right time, or they finally started later than they planned. But the person who began with $100 a month already built something powerful. Not because $100 is a large amount, but because time and consistency did the heavy lifting. Here's the reality that most people misunderstand about investing. You don't start investing when you have a lot of money. You build money by investing early, even when the amount feels small. And right now, in 2026, this lesson is more important than ever. The financial environment today looks very different from what people were used to just a few years back. Interest rates are higher than the ultra-cheap money era of the early 2020s. Inflation has slowed down compared to its peak, but everyday costs still feel heavier than before. Housing prices remain elevated in many areas, and markets continue to move up and down as the global economy adjusts. For someone who has never invested before, that environment can feel intimidating. It's easy to think, what if I start at the wrong time? What if the market drops right after I invest? What if $100 is just too small to matter? But here's something important. Investing is not about predicting the perfect moment. It's about building a system that works regardless of the moment. And that system can absolutely start with $100 a month. In fact, for many people, starting small is actually the best way to learn, because small amounts give you something incredibly valuable: experience without catastrophic risk. When beginners try to start investing with a large lump sum, emotions get involved immediately. Every market movement feels dramatic. Every news headline suddenly feels personal. But when you start with a manageable amount, like $100, something different happens. You develop the habit first, and habits are far more powerful than initial amounts. Once the habit of investing exists, increasing the amount later becomes much easier. Without the habit, even people earning high incomes often never begin. That's why in this video, we're going to break down a very practical question. How do you actually start investing in 2026 with just $100 a month? Not in theory, not with complicated financial jargon, but step by step in a way that a complete beginner can realistically follow. We'll talk about where that first $100 should go, what type of investment accounts make the most sense today, why many beginners accidentally choose the wrong assets, how compound growth really works, and most importantly, how to build a system that keeps investing automatic and stress-free. Because the biggest mistake beginners make is thinking investing is complicated. The truth is the opposite. The most effective long-term investing strategies are often the simplest ones. If you've been putting this off because you thought you needed thousands of dollars to begin, this video should change how you think about that. And before we go deeper, I want to ask you something. If you had exactly $100 to invest this month, where would you put it? Would you choose stocks, crypto, savings, or are you still unsure where to start? Write your answer in the comments below. I read the comments and it helps shape future videos. And if you want more practical, calm, realistic explanations about money, investing, and building long-term financial stability, make sure to subscribe to the channel. Now, let's walk through the exact system beginners can use to start investing with $100 per month in 2026. The first thing we need to address is a psychological barrier that stops millions of people from investing. It's the belief that small amounts don't matter. You might hear someone say something like this:
What difference can $100 a month really make? On the surface, the math does look small. $100 per month equals $1,200 per year. That doesn't sound like the beginning of serious wealth. But that's because most people think in straight lines. Investing doesn't grow in straight lines. It grows through compounding, and compounding completely changes how small numbers behave over time. Let's walk through a simple example. Imagine someone invests $100 per month into a diversified investment portfolio that earns an average annual return of around 7%. 7% is not an aggressive assumption. Historically, diversified stock portfolios have averaged more than that over long periods, but using a conservative number keeps expectations realistic. After 1 year, the investor contributed $1,200. With growth, that might become roughly $1,240 or $1,250. Not life-changing. After 5 years, contributions total $6,000. With growth, that might become around $7,000. Still modest. This is where many beginners become discouraged and stop. But something important is happening during those early years. The foundation is forming, because the longer the money remains invested, the more the compounding effect accelerates. By year 10, contributions would equal $12,000, but the portfolio value might be closer to $17,000. Now compounding is starting to show itself. At 15 years, the total contributions are $18,000, but the investment value could reach roughly $32,000. And by 20 years, something interesting happens. Total contributions reach $24,000, yet the portfolio value may approach or exceed $50,000, depending on returns. In other words, the growth begins to rival the contributions. That is the turning point of compounding. Now, imagine something else. After 10 years of consistent investing, the investor's income has probably increased. Maybe that $100 becomes $200 per month, or $300, or more. When contributions increase later in the process, compounding becomes dramatically more powerful. This is why starting early matters far more than starting big. Time is the multiplier. And once you understand that, the goal changes. The goal is no longer invest a lot. The goal becomes start now and stay consistent. Now, let's talk about the actual mechanics of starting, because knowing that investing matters is one thing. Knowing exactly where to put that first $100 is another. The first decision every beginner needs to make is choosing the correct type of account. Not the investment itself yet, the account. This might seem like a small detail, but it can make a major difference over time. Different types of accounts receive different tax treatment, and taxes quietly reduce investment growth if you ignore them. In many countries, there are 3 broad categories of investment accounts: tax-advantaged retirement accounts, taxable brokerage accounts, and savings-based investment accounts. The best choice often depends on your goals and where you live, but the principle remains the same. Whenever possible, beginners should prioritize accounts that provide tax advantages. Why? Because taxes compound just like investment returns do. If an investment grows without taxes being applied every year, the compounding effect becomes stronger. For example, retirement accounts in many countries allow investments to grow tax-deferred or tax-free until withdrawal. This means the full investment balance continues compounding over time instead of being partially reduced by annual taxes. For someone investing small amounts consistently, this advantage becomes significant across decades. Once the account type is selected, the next question becomes much more interesting. What should you actually invest in? This is where beginners often get distracted, because the financial world loves complexity. Financial media talks about individual stocks, trading strategies, market predictions, and new investment trends. But the truth is that most long-term investors do not build wealth by constantly picking the next winning stock. Instead, they invest in broad markets. The concept is simple. Rather than trying to guess which company will outperform, investors buy a piece of the entire market. This is usually done through index funds or exchange-traded funds. These funds track major market indexes, which represent large groups of companies. For example, some funds track hundreds or even thousands of companies across different industries. That means when the overall economy grows over time, the investment grows as well. This approach has several advantages. First, diversification reduces risk. If one company struggles, the impact on the overall investment is small. Second, index funds typically have extremely low fees. Fees might seem small in the short term, but they also compound over time. High fees slowly drain investment growth year after year. Low-cost funds allow more of the return to remain in the investor's pocket. Third, index investing removes the pressure of constant decision-making. You don't need to watch the market every day. You don't need to guess which stock might double next year. You simply participate in the long-term growth of the economy. And historically, that growth has been powerful. Now here's something important for beginners to understand. Markets do not move in straight lines. Even during long-term growth periods, markets experience corrections, volatility, and sometimes sharp declines. This is normal. In fact, volatility is the price investors pay for long-term returns. But beginners often misunderstand volatility. When the market drops shortly after someone begins investing, it feels like a mistake. But mathematically, early declines can actually benefit long-term investors who are consistently contributing. Why? Because regular monthly investing allows investors to buy assets at different prices. When prices fall, new contributions purchase more shares. When prices rise, the portfolio value increases. Over time, this process averages out the cost of investing. This strategy is often called dollar cost averaging. Instead of trying to guess when the market is at the lowest point, investors simply contribute the same amount regularly, and the market does the rest. For someone investing $100 per month, this strategy is extremely practical. It removes the pressure of timing the market. It replaces prediction with consistency, and consistency is what builds wealth.
Once your automatic $100 investment is set up, something subtle but powerful begins to happen. You stop relying on motivation. Most people think investing is about discipline. They imagine that successful investors wake up every month, carefully analyze markets, and manually move money around with perfect timing. In reality, the majority of long-term wealth is built by people who simply remove decisions from the process. Automation changes everything. When your investment is scheduled the same day your paycheck arrives, the money disappears before you have the chance to spend it. You adapt your lifestyle to what remains. This is exactly how retirement plans, pension systems, and institutional investors operate. They don't ask themselves every month whether they feel like investing. They simply follow the system. And once that system is running, the next step becomes surprisingly simple: choosing where that $100 actually goes. A common mistake new investors make is trying to find the perfect stock. They scroll through financial news, watch analysts debate predictions, and search for companies that might explode in value. But this approach introduces two problems. First, individual stock picking requires deep research and experience. Even professional investors with entire research teams struggle to outperform the market consistently. Second, concentrating your money in a few companies increases risk dramatically. If one company performs poorly, your portfolio suffers. That's why most beginner investors in 2026 start with something much simpler: broad market index funds. Index funds are designed to track the performance of an entire market or sector instead of relying on a single company. When you invest in a total market index fund, your money is automatically spread across hundreds or even thousands of companies. Technology companies, healthcare companies, banks, energy firms, consumer brands. Instead of betting on one winner, you invest in the growth of the entire economy. This diversification reduces risk while still capturing long-term market growth. And the best part is that many of these funds allow fractional investing. That means your $100 doesn't need to buy a full share of anything. It simply purchases a small slice of the entire fund. Even small contributions start building a diversified portfolio immediately.
Once your first investment is made, the next important concept to understand is time. Most people underestimate how powerful time becomes when combined with consistent investing. If someone invests $100 once, the result will likely feel insignificant. But when that same person invests $100 every month for years, the effect multiplies. This happens because of compounding. Compounding means that your investments begin generating returns, and those returns then begin generating their own returns. In the early stages, progress looks slow. Your first few $1,000s may take months to accumulate. But as the balance grows, the gains begin to accelerate. At some point, the growth from your investments may become larger than the money you personally contribute. This is the moment when investing starts to feel different. You are no longer just saving money. Your money is working. To understand how this plays out, consider a simple example. If someone invests $100 per month and the market grows at an average annual return of around 8%, the numbers begin to compound steadily. After 1 year, the account may hold around $1,250. After 5 years, the balance could reach roughly $7,500. After 10 years, it may grow to around $18,000. But the most interesting part appears later. After 20 years, the same $100 monthly investment could grow beyond $60,000. After 30 years, it might approach or exceed $150,000 depending on market conditions. All from a contribution that many people spend on small daily purchases. The key difference between people who achieve these results and those who never start is rarely income. It's consistency. And consistency becomes much easier when the strategy stays simple. Many experienced investors follow a structure known as the core portfolio. Instead of constantly chasing new opportunities, they focus on a few foundational assets. A typical beginner-friendly structure might include a total market index fund that captures broad economic growth, an international index fund that provides exposure to companies outside your home country, and sometimes a small allocation to bonds for stability. For someone investing $100 per month, this structure can still work. For example, $70 could go towards a total market index fund. $20 could be allocated to an international fund, and $10 could go into bonds or remain in cash equivalents. This approach spreads risk while maintaining strong growth potential. But investing isn't only about choosing assets. Behavior plays a much bigger role than most people realize. During strong market years, investing feels easy. Account balances rise, financial news becomes optimistic, and people feel confident. The challenge appears during downturns. Markets occasionally fall, sometimes sharply. Prices drop, headlines become alarming, investors panic. This is when many beginners make their most expensive mistake. They stop investing. Or worse, they sell their investments after prices have already fallen. Ironically, market downturns are often the moments when consistent investors benefit the most. When prices fall, your monthly $100 buys more shares. Instead of purchasing assets at high prices, you accumulate them at discounted levels. This process is known as dollar-cost averaging. Over time, it smooths out market volatility and reduces the risk of investing all your money at the wrong moment. Rather than worrying about timing the market, your strategy focuses on time in the market. The longer your money remains invested, the more opportunities compounding has to work. Another important factor in successful investing is cost. Fees may appear small, but they can quietly reduce long-term returns. Many actively managed funds charge management fees of 1% or more per year. This might not sound significant at first.
But over decades, that 1% can reduce your final portfolio by tens of thousands of dollars. Low-cost index funds were designed specifically to minimize these expenses. Many now charge expense ratios well below 0.10%. This means the vast majority of your investment growth stays in your account rather than being paid to fund managers. The difference becomes dramatic over long periods of time. Lower costs mean more compounding working in your favor. As your investing routine becomes more comfortable, you may eventually want to increase contributions, but the beauty of starting with $100 per month is that it builds the habit first. Once investing becomes part of your financial identity, increasing the amount becomes far easier. A salary raise might allow you to increase contributions to $150. A paid-off loan might free another $100. Small adjustments over time can dramatically accelerate portfolio growth. But even if the contribution never changes, the long-term results remain meaningful. Consistency alone can build significant wealth. Another advantage modern investors have in 2026 is access to technology. Investment platforms now provide automatic rebalancing, goal tracking, tax optimization tools, and educational dashboards. These tools help investors stay aligned with their long-term strategy. Instead of reacting emotionally to short-term market moves, they can focus on steady progress. Many platforms even display projections that show how today's contributions may grow over future decades. Seeing these projections can reinforce the motivation to continue investing, because the numbers eventually reveal a simple truth. Wealth rarely appears overnight, but it grows quietly in the background when systems are allowed to operate for long periods of time. At some point, the investor who began with $100 per month may look back and realize something surprising. The hardest step was never choosing the perfect investment. It was simply starting. And that first small monthly contribution created a path that would eventually lead to financial independence.